is Lucia Perry, and I'm here to give my fellow TurboTax employees and oil and gas interest owners tips on how to turbo their taxes.
Hello, TurboTax teammates. As you know, Lucia and I chose to do our project on oil and gas interest, and we thought it might be a good idea to just give you a little bit of background information on some of the key aspects of reporting this type of income on the tax return. When a TurboTax customer type of industry, there's mutual funds, which we won't be discussing today. There's partnerships, which Lucia will be telling you a little bit about, and there's royalty interest and working interest.
Now, Tovah, what do you see as being the difference between a royalty interest and a working interest?
We're probably mostly familiar with. You collect royalty income, you report it on the Schedule E along with any expenses you might have. A working interest, however, is a little bit different in that this income is reported on a Schedule C because it's subject to self-employment tax. A taxpayer that has a working interest in an oil and gas company is responsible for a portion of the costs that are associated with exploration, drilling, and production. So a royalty interest, they don't incur any of those costs, but a working interest does. So basically, if you own 50% working interest, then you're responsible for 50% of these expenses. Oh, another key aspect about the working interest is that the tax code specifies that it's not considered a passive activity. This is good. That means that your net losses can be used to offset any other form of income, which of course is going to be a huge benefit to the investor. A royalty interest, on the other hand, is considered to be passive.
Isn't there a special rule about intangible drilling costs that you get for holding an interest in oil? Isn't there a special rule about intangible drilling costs that you get for holding an interest in oil and gas companies?
Yep, there is. The IRS allows intangible drilling costs to be fully deducted in the year they are incurred. These include everything that's necessary for drilling, except the actual drilling equipment, but things like the labor, the chemicals, the mud, the grease, or any other miscellaneous item that's necessary. These are all allowed. The tangible drilling costs, which include the cost of the equipment, are amortized or depreciated over 7 years.
Is there any election that they need to make in order to be able to fully deduct these costs?
In the first year that they are paid or incurred. Now, this is really important because the taxpayer must do this on the first return that they have IDC costs. If you fail to deduct these costs, then basically they assume that you're electing to capitalize them and recover it through depletion. And just as a side note, when I was doing my research, I found that there were several letter rulings where the IRS allowed elections made on delinquent returns because these were the first returns that had IDC on them, but they denied the election when the taxpayer amended the return. And this is good to know because we don't want to tell our TurboTax customers to amend a return to make the election because it's probably going to be overturned. And when I was doing my research, there's a really good IRS website that summarizes the IDC cost, and Lucia and I will include it in some part of our workup paperwork or in something that we send to you. So look for an IRS website for Pub 535, and that's going to have a real good recapture of what I just talked about.
Okay. You can tell they've already drilled because they're flaring gas, which means they've already hit. That means at this point, they're ready to put in the pumping units and the tanks, but all the drilling equipment, the things that we call intangible drilling costs, are already gone.
As Tovah mentioned earlier, not everybody gets every deduction. It depends on what kind of interest you own in the property. Now, everybody does get depletion, but not everybody gets percentage depletion. Do you know percentage depletion is subject to loss limitations onto whether or not you actually can use it?
For some key points about working interest in an oil and gas company. Now, Lucia worked on partnerships and trusts. Okay, Lucia, what type of oil and gas companies usually give out K-1s?
Typically, the only type of investment the average investor has in an oil and gas interest that's going to result in a K-1, it is either going to be a royalty interest trust or a partnership like a publicly traded partnership. In addition, both of these entities may give you a 1099 if there's other income than royalty, such as interest or dividends.
This slide will help you keep track of which is which.
Okay, is there a difference between how holders in royalty interest trust and partnerships report their income?
Oh, yeah. Oh, yes. Royalty Interest Trust treat it like any other royalty, and they use Part 1 of the Schedule E. But the publicly traded partnerships use the back of the Schedule E in Part 2.
Do the companies help their investors in royalty interest trusts complete their taxes?
Many of the companies do offer help for their investors. Many of them have tax packages on their website, like this one, that have sample forms in there to show where you should report your income. Also, some of them have sites where you can download your K1 if you've lost a copy. And if you have a royalty interest trust, we have some links to some sites to get your tax information listed below.
Oh, that's good to know. That's really good to know. What about publicly traded partnerships? Is there an advantage for using TurboTax Desktop for a publicly traded partnership?
Oh, I got it.
Absolutely. TurboTax Desktop is unique in its functionality because many oil and gas partnerships make TXF files downloadable from their website so that partners can download their TXF files and import them into the desktop version of TurboTax without having to type their information in. And so far, TurboTax Desktop is the only version with this functionality.
Well, that's wonderful. Well, what if my company doesn't offer a TurboTax download file?
We also recommend using TurboTax Desktop if you plan to enter your numbers from your K1 yourself. One of the things that you can do is by going into Desktop, you can go to the Forms view and you can actually look at your Schedule K1 information and your Schedule E to make sure you've got them in and type.
A good way to double check your entries using the form modes. I think everybody agrees desktop version is a really good way to go. Well, that's it. That's what we have for working interest and partnerships.
And now we've reached the end of our video, and we wish you all many happy returns. What follows next is going to be some instructional tools for TurboTax users on how to enter their taxes, and there's going to be a brief video on how to use the Forms view and another one on how to use the TXF